Everyone's asking the same question. Am I too late for crypto? Here's what nobody's telling you. Bitcoin already made its millionaires. That ship sailed. But here's the thing. The wealth creation in crypto, it's just shifting. It's moving somewhere else, somewhere most people aren't even looking yet. And no, this isn't another hype video telling you to throw money at random coins. We're doing this differently. Full transparency, real opportunities, actual risk assessment. Because in 2026, crypto isn't about gambling anymore. It's about understanding where the infrastructure is being built, where real adoption is happening, where institutions are quietly positioning themselves. Bitcoin was chapter 1. We're now entering chapter 2, 3, and 4, all at once. And if you know where to look, the opportunity is bigger than most people realize. So let's break it down. No fluff, no guarantees, just the truth about where value is moving next.
Remember when crypto was just price charts? Buy low, sell high, pray it moons? Yeah, those days are over. What's happening now is fundamentally different. Crypto has grown up. It's not a teenager anymore. It's building actual infrastructure. We're talking payments that settle in seconds, smart contracts managing billions, entire financial systems running without banks, AI agents that need their own payment rails, real estate being tokenized, and it's all happening right now. Think about it like this. The internet didn't make people rich by itself. It was the infrastructure built on the internet. Amazon, Google, Facebook, the platforms, the tools, the systems everyone ended up needing. That's where we are with crypto right now. But here's the reality check, because I promised you transparency. Most tokens will fail. Like 95% of them, maybe more. Regulation is still being figured out. Hacks happen, projects collapse, and anyone telling you this is a guaranteed path to wealth, they're either lying or trying to sell you something. The winners in this space, they're not the hype coins. They're the platforms, the infrastructure, the projects solving real problems for real users. And that's exactly what we're going to explore. Starting with the elephant in the room.
Ethereum. You've heard of it, but do you understand why it matters in 2026? Here's what happened. Ethereum became the operating system of digital finance, like Windows for computers, but for decentralized apps. Except it had one massive problem. It got too popular. Too many people using it meant fees went crazy and transactions got slow. Imagine trying to run the entire world's financial system through one courthouse. That's what Ethereum was dealing with. So what's the solution? Layer 2 networks. Think of Ethereum as the main courthouse, secure, trusted, final. And Layer 2s, they're like branch offices spread across the city. They handle the day-to-day work, but they're still backed by the main courthouse's security. Faster, cheaper, but still trustworthy. Networks like Arbitrum, Optimism, ZK Sync, Base. These aren't just technical experiments anymore. They're processing billions in transactions. Real users, real apps, real economies forming around them. And here's where it gets interesting for wealth creation. These Layer 2s, they're generating revenue. Every transaction, there's a fee. That fee gets distributed. As activity grows, revenue grows. It's not speculation, it's math. It's business fundamentals, just on-chain. But, and you knew there was a but coming, there are risks. Smart contract vulnerabilities exist. Competition is fierce. Some of these L2s might not survive. Token economics aren't always clear. And regulatory pressure, it's real. The key lesson here? Infrastructure tokens aren't meme coins. They're the economic rails everything else is being built on. And rails have value when everyone's using them. Which brings us to something even more fascinating.
What if I told you that in the next few years, AI agents will be buying and selling things without any human involvement? Sounds like sci-fi, right? It's already starting. Here's what's happening. AI is getting good, really good. These AI agents are starting to act like digital workers, running tasks, making decisions, accessing resources. But here's the problem they face. They need to pay for things. They need compute power, data,
services, identity verification. And that's where crypto comes in. Traditional banking, AI can't just walk into a bank and open an account. But crypto? It's programmable money. AI agents can hold it, spend it, earn it, autonomously. Machine-to-machine payments happening at the speed of code. The opportunity here isn't just buying AI coins. It's understanding what infrastructure these machines will need. Decentralized compute networks, where AI can rent processing power. Data marketplaces, where AI can buy training data. Agent networks, where AIs can collaborate. Think about it. If AI adoption explodes, and these agents need crypto rails to function, what happens to the value of those rails? Now, transparency time. This space is full of hype. Projects promising AI revolution while having zero users. Tokens with massive valuations but no real product. And the regulatory landscape? Total unknown territory. Plus, there's the centralization risk. If a few big players control AI compute, does decentralization even matter? These are real questions, no easy answers. But the core thesis? AI and crypto merging into an autonomous digital economy? That's not hype. That's where technology is heading. And being positioned early in the actual infrastructure, not the vaporware, that could be significant. Which leads us to something traditional finance is finally taking seriously.
Okay, let's talk about something that sounds boring, but might be the biggest wealth opportunity of the decade. Tokenizing real-world assets. I know, it doesn't have the sexy appeal of AI or memes, but stay with me, because this is where trillions of dollars are moving. Here's what tokenization means in simple terms. Taking traditional assets, stocks, bonds, real estate, even treasury funds, and representing them as tokens on a blockchain. Why? Because a blockchain makes them liquid, tradable 24/7, divisible, and automated. Imagine buying $100 worth of a luxury apartment in Dubai, or trading bonds at 2 a.m. on a Sunday, or having your stock dividends automatically distributed in real time. That's what tokenization enables. And institutions? They're all over this. BlackRock is doing it. JP Morgan is doing it. Why? Because it cuts costs, increases transparency, and opens up markets that were previously exclusive. The wealth opportunity here isn't buying tokenized real estate directly. It's owning pieces of the infrastructure making tokenization possible. The compliance protocols, the custody solutions, the trading platforms, the oracles connecting real-world data to blockchain. Be early to the rails, not the individual trains. But, reality check, regulation here is slow. Legal frameworks take time. Adoption will be gradual, not overnight. And there's friction everywhere. Banks, lawyers, governments, all moving at their own pace. Still, when institutions tokenize trillions in assets, they're going to use someone's infrastructure. The question is, whose? Now let's talk about something that's been quietly rebuilding. DeFi, decentralized finance. You heard about it in 2020, 2021, probably during the DeFi summer hype. Then it crashed hard. Lots of people lost money. Projects collapsed. But here's what you might have missed. It didn't die. It evolved. DeFi 2.0 isn't about unsustainable yields and Ponzi-like token mechanics anymore. It's about building actual financial tools that work. Lending protocols where you can borrow or earn interest without a bank. Decentralized exchanges where you trade without giving up custody. Stablecoins that hold their value. And here's the kicker. These protocols are generating real revenue, real fees, from real users. Perpetual DEXs, platforms where you can trade with leverage, 24/7, no KYC. They're doing billions in volume. Liquidity protocols, they're the engine making all of this possible. Derivatives markets, just getting started. The strong projects have three things: actual fees coming in, proven security track records, and user bases that keep growing. But let me be straight with you about the risks. Hacks still happen. One smart contract bug can drain millions. Governance can be manipulated by whales. Yields that look amazing today can collapse tomorrow. And regulations?
still being figured out. DeFi is powerful, but it's also unforgiving. This isn't passive income you can ignore. It requires understanding what you're doing. The opportunity? Owning governance tokens of protocols that become the financial infrastructure of the future. The risk? Most won't make it. Speaking of infrastructure,
You know what made more people rich during the gold rush? It wasn't finding gold. It was selling shovels. Same principle applies here. In crypto, infrastructure tokens are the shovels. These are the projects that everyone else depends on, the boring stuff that makes the exciting stuff possible. We're talking about oracles, feeding real-world data onto blockchains, data indexers, making blockchain data searchable and usable, bridge networks, moving assets between different blockchains, security layers, protecting everything from attacks, show dependency web. Here's why they matter. Every app, every protocol, every project needs these. An oracle goes down, hundreds of protocols can't function. A data indexer stops working, developers are stuck. A bridge gets hacked, billions are at risk. These infrastructure players aren't flashy. They don't promise 1,000x returns overnight, but they generate steady revenue because everyone needs them. And in a maturing market, that matters. Think of it like investing in AWS instead of every individual app running on AWS. You're betting on the foundation, not the individual buildings. Now, risks? Absolutely. Centralization is a concern. Some of these decentralized networks are more centralized than they admit. Fee compression could happen as competition increases, and new technology could make current infrastructure obsolete. But if you're looking for lower volatility exposure to crypto growth, infrastructure tokens are worth understanding. Let's shift gears to something more controversial.
gaming and crypto. This combo has been hyped to death. Promises of play-to-earn riches, virtual land selling for millions, the metaverse being the next internet. Most of it was not great, let's be honest. But, and here's where it gets interesting, some lessons were learned. The core idea isn't wrong. Letting players actually own their in-game items. That makes sense. Creating economies where value flows to players, not just corporations. That's powerful. The problem was execution. Games were terrible. Economies were broken. Everything was designed around speculation, not fun. But 2026 is different. We're seeing actual games that are good, fun to play, not just investment schemes disguised as games. Economies designed by people who understand game design, not just tokenomics. The opportunity here isn't buying land in random metaverses. It's identifying platforms building real virtual economies, marketplaces where actual trading happens, infrastructure supporting thousands of games, not betting on one. Because here's the truth, most individual games will fail. That's just how the gaming industry works. But platforms that support many games, those have a better shot. Risks? Massive. User churn is brutal in gaming. Hype cycles come and go, and unsustainable economies collapse fast. Most Web3 gaming tokens will go to zero. But if someone cracks the formula, real fun plus real ownership, the upside is enormous. Gaming is a massive industry. Adding real digital ownership to it, that could reshape everything. Now, let's address the elephant everyone's thinking about.
All right, meme coins. The thing everyone wants to ask about but is afraid to bring up in serious crypto discussions. Let's just talk about it honestly. Meme coins exist. Some people make life-changing money on them. Dogecoin made millionaires. Shiba Inu made millionaires. Newer memes still pop up and go crazy. But here's what nobody tells you in those "I made $10,000 from $100" videos. For every person who made money, hundreds lost everything. The timing has to be perfect. You have to get in early, not when YouTube is already talking about it. You have to know when to sell. And that last part? That's where most people fail. Meme coins aren't investments. They're not backed by revenue or technology or utility. They're pure social, cultural, viral phenomena. They're lottery tickets, and treating them like anything else is lying to yourself. Why do they work when they do? Community, narrative, cultural moment.
sometimes even spite against the system. It's not rational, it's emotional and social. So here's my take. If you want to throw some fun money at a meme coin, money you could literally light on fire and be okay with, go ahead. Understand it's gambling. Don't tell yourself stories about fundamentals or utility. But if you're building actual wealth, meme coins aren't your strategy. They're your side bid, your 1 to 2% moonshot allocation, not your portfolio. Anyone selling you a course on meme coin mastery is selling you a dream. The real money in memes, it's made by insiders who launch them, not retail who buy them. Okay, let's get practical.
So, you've heard about all these sectors. Now what? How do you actually position yourself? Let me break down a framework that makes sense. Not financial advice, but a logical approach. Think of your crypto allocation in layers. Layer 1, the core, 50 to 70%. Bitcoin, Ethereum, the foundational assets. Not exciting, but stable relative to everything else. Your anchor. Layer 2, growth, 20 to 30%. Layer 2 networks, infrastructure tokens, RWA protocols. Projects with real users and revenue. This is where you're betting on adoption, not speculation. Layer 3, high risk, 10 to 20%. AI crypto plays, DeFi protocols, Web3 gaming platforms. Higher potential, higher risk. Do your research here. Layer 4, speculation, 0 to 5%. Meme coins, microcaps, lottery tickets. This is money you're okay losing completely. Key principles. Never invest money you need for bills, rent, or emergencies. Never invest more than you can afford to lose completely. Position sizing matters. A 10x on 1% of your portfolio is just 10% gains. Security is non-negotiable. Hardware wallets, strong passwords, no exchange storage for large amounts. And here's something nobody talks about enough: knowing when to take profits. Making money isn't the hard part. Keeping it is. Set rules before you invest. If this 3x's, I'll take out my initial investment. If this hits X value, I'm selling 50%. Emotion is your enemy in crypto. Rules protect you from yourself. But before we wrap up, I need to say something important.
I'm going to be straight with you about something. Everything I've shared, every opportunity, every sector, every strategy, comes with zero guarantees. None. Not from me, not from anyone. This isn't like putting money in a savings account. This isn't index fund investing. Crypto is volatile, unpredictable, and still figuring itself out. You could make incredible returns. You could also lose everything. Anyone promising you wealth is either naive or dishonest. What I've given you is analysis, context, and frameworks, not prophecies. Real wealth in this space comes from understanding systems before others do, managing risk relentlessly, thinking in years, not days, never stopping your education, staying humble when you win, and learning when you lose. The millionaires crypto creates in 2026 and beyond won't be lucky gamblers. They'll be people who understood where value was moving, positioned early but carefully, and had the discipline to stick to their strategy. Discipline beats FOMO, knowledge beats hype, patience beats panic. That's it. That's the real secret.
So, here's where we are. Crypto in 2026 isn't what it was in 2017. It's not even what it was in 2021. It's evolving from a speculative casino into actual technological infrastructure. And that shift, that's where opportunity lives. Whether it's Ethereum's Layer 2 ecosystem, AI agents needing payment rails, real-world assets moving on-chain, DeFi rebuilding properly,
or infrastructure everyone will depend on. The common thread is this: infrastructure creates wealth more reliably than speculation. Will you get rich overnight? Probably not. Will you need to do actual research instead of following Twitter hype? Absolutely. Will there be setbacks, hacks, regulatory chaos, and projects failing? 100%. But here's what's also true. We're watching the financial system rebuild itself in real time. The internet took 20 years to reshape the world. We're maybe 5 years into crypto doing the same thing. Being early doesn't mean being reckless. It means being informed, strategic, and patient. The best advantage you can have? Education. Understanding what you're actually investing in, not just following narratives. So keep learning. Stay skeptical. Manage your risk. And never invest based on FOMO or someone else's promises. The next wave of crypto millionaires? They're being made right now, quietly, by people paying attention to infrastructure, not hype. The question is, are you one of them?
If this helped you see crypto differently, hit subscribe. If you want deeper analysis on any of these sectors, let me know in the comments. And remember, do your own research. Always.